What we're going to talk about in this video is how to do a bank reconciliation. Bank reconciliations are an important internal control surrounding cash. We have to control cash well because of its liquidity, i.e. easy to walk away with if not well controlled. So what companies will do is they'll do a bank reconciliation whereby they'll compare their books to the bank statement. When I say books, they're going to compare their bank statement balance to their cash balance per their books. And it's rare that they are the same because of timing differences. Well, the idea behind the bank reconciliation is that we're going to basically assume a perfect world and that information is going to be reflected immediately. So what you have here, look and visualize two parties. You got the bank and you got the books or the company, and that they're telling each other information. Whatever the bank is telling the company about for the first time will go on what's called the book side of the bank reconciliation, and whatever the company knows that it's done that the bank hasn't yet reflected or doesn't know about will go on this side. So let's go through some examples of what they call reconciling items. The first one here is we have outstanding checks. What that is the company has written $1,600 of checks that haven't yet cleared the bank. So the company's reduced its cash already. The bank has not. What we want to do is basically fix the bank balance so that it reflects checks that have already been written. So what you would do there is you're going to deduct that from the bank balance because that's what the bank will do once they clear. The next item is a bank service charge of $30. That's the bank telling the books, you don't have $30 that you thought you have. So we have to reduce our balance. So you're going to reduce it by the bank service charge of $30. The deposit in transit, what that is that the company has made a deposit, but the bank hasn't reflected that yet. It hasn't cleared the bank. So when the bank does get that deposit, it will add it in. So there's your $1,800, and that's going to go to increasing your bank balance. Now, as far as the customer's NSF check, what that means is that we have a bounce check. In other words, a customer has written a check and there was not sufficient funds, NSF, so that the deposit this company made that it, from receiving that check was no good. So the bank's saying, I'm not adding it in here and you should take it out of here because you had originally added that in as a deposit. So what we need to do is deduct that from the book balance. The last one here, EFT, that stands for electronic funds transfers, and that basically is where a customer or somebody has made a direct deposit into your bank account. Now there could also be EFT disbursements or payments. That's basically where the company has payments made directly from the bank to whoever they owed money to. So with this EFT, what that basically is the bank has received this this 1,000, so it's part of the 8,000. The book doesn't know, or the company doesn't know about it, so now the company has to fix its books. So $1,000 is going to be added to the company's cash balance. Now this is where you hope everything is done properly. If there's no errors, your balances should equal, and we have 8,200 on this side and 8,200 on that side. Now what we have done is we've arrived at the true cash balance. Now the only thing is, now this is a piece of paper. It hasn't actually adjusted our book balance. Right now our cash balance per our accounting records, has 74 in it, and what we need it to have in there is 8,200. So we've actually got to make entries to reflect these transactions or these items, these reconciling items. The first one is that receipt from, we'll say a customer from services on account. So we're going to add 1,000 to our cash to get it to 84. And the other side, you would need a little more information, but I'm going to tell you it's from a customer, and they had owed us $1,000. So you're collecting your receivable. So 1,000 and 1,000. The next one is the bank service charge. That's going to reduce your cash. They would probably call that miscellaneous expense, or bank service charge expense. Lastly, NSF check. Now, as a company, I would go back after the customer. I mean, maybe it was an honest mistake, but in any event, at this point, we have to subtract it from our cash. What I would do is add it back into receivables and rebill the customer. In fact, you could probably even argue to pass on this miscellaneous expense by not debiting this, but increasing this to 200. The end result is our cash balance will now have the correct balance of 8,200 in there. Now, if there's any errors, if these don't agree, a good technique is to take the difference and look for that amount, or take the difference and divide by 2 in case you added something twice, or you should have maybe subtracted something. So that is a bank reconciliation, and it should be done by somebody who doesn't have access to cash and who doesn't have access to the accounting records. The accountants should actually make these entries. And that's the bank reconciliation.